investment properties and second homes, and really what your options are for obtaining the right mortgage for those specific type of uses. It's not every bank that can write these, and it's not every bank that can execute this in such a way. Northpointe does a fantastic job. So we asked Paul Salcone to take some time out of his busy schedule to come talk with us today. Paul, welcome back to the program.
Thank you, Amelia. I appreciate you having me on again. So second homes, I'll start with second homes. Obviously, it's a hot topic in Rhode Island and southeastern Mass as well, Connecticut, very hot topic. A lot of people are looking at buying a second home. They spend some time in the summer or maybe even the winter months. And, where do we get financing? Obviously, everyone knows how to get a mortgage, yes, but what programs are available for second homes? What options do we have? And to be honest with you, second homes can be also a condominium. It doesn't have to be a home per se. So it could be a condo or a actual single family home. Typically, a multifamily does not qualify for a second home. That'll be more of investment property. So I just want to make that clear. But with second homes now, we have a program called Conforming Advantage. This program, why it's so popular is that, number one, it allows as little as 10% down. And with credit scores, we can go as low as 640 on a credit score. Wow. So that this something opens up some options, but also with the pricing, that's key, because what the Fannie Mae and Freddie Mac did a couple of years ago was they basically caught wind that some people were using second homes as investment properties. Because of that, their pricing now is more consistent with what investment properties had. What I mean by that is rates are a little bit higher, as well as closing costs being significantly higher. So that is something with conventional you can still do, but again, your pricing's higher. So we have a Conforming Advantage program at Northpointe where it has all the qualities of a conventional loan, but it doesn't have the pricing hits and the adjustments to closing costs as well. So just to throw a number out there, let's just say hypothetically speaking, a 30-year mortgage is 6.5% right now. Yeah. If most second homes, you're looking at a rate probably closer to 7.5%. And then also on top of that, you're paying probably 2 or 3 points up front in closing costs. Wow. With our Conforming Advantage program, we can get you a rate probably about, say, 6.75, maybe 0.25% higher than traditional loans, but the closing costs don't change at all, meaning there's no points to be paid up front. Or if you want to pay to buy down, you can, but it's not mandatory. So what that means is if someone's buying a home 10% down, let's say a house is, $500,000, 10% down is $50,000. Closing costs are in the 10,000 window. It's not a bad investment for someone who really wants to live in the house. And just one other thing I want to mention about second homes, in order to be a second home, you only have to live there 2 weeks or more a year. So it doesn't, most people I think could fit that. Would you agree?
Yeah, I would say so too. And you get your tax benefits from it. I think in total between both your properties, you can write off up to $10,000 in property taxes, but also the mortgage interest, I believe, on both mortgages is completely complete write-off.
Correct. So that's another advantage there. So that's one of the programs. And we also have, the conventional financing, which everyone knows about. And that one, usually it's 10% down as well. Some require up to 20% down. But the pricing, like I said, is usually about 1% higher. So that's why the Conforming Advantage program actually just did one last night. Client in New Hampshire, North Conway, just got a condo under contract. We went with the program, and he was very happy with the rate as well as closing cost. So that's the second home program in particular I wanted to focus on. It's something that we have that's more unique. The bank we work out of, it's conventional financing, but this bank is out of Indiana that has a special program that Northpointe is able to write in all 50 states. So, and then next, Emilio, I know you talk about investment property as well. And, I figure that's something else that comes up a lot, especially in this market. A lot of people out there looking to, make some, I guess, income each month on the property. Also love to have, the extra houses. People love their investments. So I would say conventional is still an option. We all know of. It's 20 to 25% down for a multifamily home, depending on credit score. We can do 15% down for a single family home or a condo on investment properties. And that's with conventional financing. Wow. But conventional, everyone has. What I like to talk about a little bit is the portfolio loans. So one in particular, and I've actually done at your office, I think I've done a couple of these, is a DSCR loan. These are very popular now. Essentially, they're a no-doc loan. What does that mean, no doc? Well, that basically means I don't need any income documentation. So essentially, we just need to run your credit, verify your down payment of a minimum 20% on these. And then obviously you have to have the rental income needs to cover the mortgage. Mm-hmm. So in a nutshell, what does that mean? Let's just say easily we have a 3-family home, and let's just say that fair market rent per unit, let's make it easy math, is $2,000 per unit. So you have a 3-family at $2,000 per unit. That's $6,000 a month the property generates. So as long as the new mortgage, principal, interest, taxes, and insurance is at 6,000 or less, you're approved. There's no W-2, tax return, pay stub. So, I mean, you can see how for an investor who maybe, has a numerous amount of properties on the tax returns, maybe their income on paper, isn't, with the write-offs isn't as much as they actually make. This is a way to get into investment property with, the 20% out of pocket and not worrying about hard money or paying higher interest rates or, maybe having to go with a different route.